You see these stories all the time, right? Incredible, mind-blowing stock market wins. But how often do you get to see one taken apart, piece by piece, to see how it actually happened? Well, that's exactly what we're going to do today. We are doing a forensic deep dive into a massive 242% gain in a biotech stock called AMLX, all to answer one big question.
And let's just start with the results, because it's a big one. 242%. Just let that sink in for a second. This wasn't some hypothetical trade. This was the real return. And a number like that, it just immediately makes you ask, was this just a lucky shot in the dark, a random bet on a volatile stock that just happened to pay off? Or was there a methodical, multi-layered process at play here? Something that we can actually learn from? That's what we're here to find out. We're going to deconstruct this trade layer by layer and show you the anatomy of a true winner.
All right, let's start at the very beginning with layer one, the financial foundation. Because look, before you can even dream about explosive growth, you have to make absolutely sure the company you're looking at is built on solid ground and not, on sand.
Now, to really get why this is so important, you have to understand the biotech sector. I mean, it is notorious for companies that just burn through cash with no profits anywhere in sight. But AMLX was different. It was a complete financial outlier, and that was our very first major clue.
Here's Exhibit A, a debt-to-equity ratio of just 0.38. Now, what that number tells you is basically how much a company owes versus how much it owns. Anything under 1.0 is considered pretty healthy. 0.38? That is incredibly healthy. It meant AMLX wasn't drowning in debt, which in this industry is a massive green flag.
And you know what? It gets even better. Their interest coverage was 6.5 times. This tells you if a company can actually afford to pay its bills. It means AMLX was earning enough cash to pay the interest on its debt more than 6 times over. So this company wasn't just surviving, it was financially rock solid.
And it wasn't just stable, it was actually getting more and more profitable. We looked at these 3 key metrics you see here, and they all measure how good a company is at turning investments into actual profit. And the crucial thing is, all of them were trending up. The financial foundation wasn't just safe, it was actively getting stronger every single quarter.
So let's move on to layer 2. A healthy company is great, right? But for a huge move, you need the wind at your back. You need the market itself on your side. This is all about riding a powerful thematic wave.
So back in 2025, this really fascinating shift started to happen in the market. Big money, I'm talking institutional capital, began moving out of all the speculative stuff and started hunting for something very, very specific. The sources call this the asymmetric biotech rotation.
Investors were just tired of hype. They wanted efficiency. They were looking for biotechs that had clear, upcoming news events, that were disciplined with their money, and, importantly, showed signs of quiet institutional buying. See, AMLX wasn't some loud, flashy meme stock. It was the perfect fit for this new, smarter narrative that was taking hold.
Okay, this brings us to layer 3, and this is where it gets really, really interesting. We've got a solid company, we've got a favorable theme, but how do we know if the big informed players, the so-called smart money, are actually getting in on the action?
To find them, you have to look into something called dark pools. Now, it sounds mysterious, but it's actually pretty simple. These are just private stock exchanges. They're where the big institutions can buy and sell huge amounts of stock without causing big price swings on the public market. It's basically where they operate in stealth mode. And here is the proof. On average, about 46% of a stock's trading happens in these dark pools. But as you can see right here in this chart, AMLX's activity jumped to nearly 55%. That's a huge deviation. That is a clear, blinking signal that large institutions were quietly buying up every share they could get their hands on.
But we can go even deeper and decode that activity. Looking at the data, we saw 3 things. First, massive block trades. That's a sign of serious buyers with deep pockets. Second, these institutions were paying a premium, almost 2% above the average daily price. Think about that. They were so desperate to get in, they were willing to overpay. And third, the buy-to-sell ratio was just incredibly strong. The interpretation here is crystal clear. This was high-conviction institutional buying, period.
But the signal was even stronger than that. It wasn't just anonymous institutions. The people who know the company best, its own executives, its insiders, they were also putting their own money on the line.
This timeline shows a really strategic pattern. Just look at quarter 2. The CEO and board members made strong buys right before news on their clinical trials was expected. When the insiders and the big institutions are aligned like this, buying at the same time, well, that's one of the most powerful signals you can ever find.
So we have our case, strong finances, a market tailwind, and the smart money is piling in. The final layer, layer 4, is all about timing. It's the technical trigger that tells you the exact moment to act.
And that moment was identified with incredible precision, $3.87. This wasn't a guess. It wasn't a ballpark figure. It was the specific price point where all of the technical evidence converged into one.
So here's what that price meant. First, breaking above it confirmed all that institutional buying we'd been seeing. Second, it crucially invalidated a chart pattern that suggested the stock was about to fall. It's like a danger signal was just disarmed. And finally, all the key momentum indicators turned up at once on a huge surge in volume. Every single signal on the chart was flashing go.
And that brings us to the synthesis. See, this wasn't about one signal in isolation. It was about how all 4 of these distinct layers came together to build what you could call a multi-signal superstructure of conviction. So let's just put it all together one last time. The process started by asking, is this company safe? The financials said yes. Then, is the market on its side? The thematic rotation said yes. Then, is the smart money in? The data flows confirmed that they were. And only then, only after all of that was confirmed, did we ask, is it time to act? And the technical chart gave the final, definitive yes.
So, the crucial point is this, that massive 242% return wasn't the result of chasing a single tip or some magic indicator. It was an opportunity created by the convergence, the coming together of multiple independent streams of data, all pointing in the exact same direction.
And that leaves us with this final thought, which really encapsulates the entire process. We don't just pick tickers, we build conviction through forensic analysis. It shows that the biggest wins might not come from a single lucky break, but from a deliberate, repeatable process. Which makes you wonder, how much of what we call luck in the market is actually just a system that we haven't taken the time to see?